Hello everyone and good morning. Today, Saturday, November 13th, we are running our module 4 sessions, and this 30-minute session is for homework from previous module and for catch up of some materials. If you want me to review your homework in the live mode, send me the link or tell me in a chat that you want me to do so. Also, please let me know if we have any quality issues. I will do one more thing. I will send an email notification about live so that if someone monitors everything through email, so they will know that that we are live. Okay, just one more second. Okay, so I would like to start today's session with some retrospective review of our module. Here we have a course folder, and in the course folder, in one of modules, I provided, I believe it was module 1. Let's see. No, not here. I provided 10 steps to learn accounting, and I wanted to catch up. Not here. Was it module 2? Okay. So I wanted to do a quick catch up of what steps have we already done, and some of them are of recurring nature. So to grow and develop in the accounting profession, you will need to repeat those steps from time to time or continuously from year to year. So we did some understanding of the accounting transaction and accounting entity. And these concepts are mostly common sense, but we dig a bit into the theory and explain the substance of these concepts. Understand accounting equation, define its components, and why debits are equal credits. We did that too. So assets should be equal to liabilities plus equity, and that's because equity is defined as whatever is left of your assets after liabilities are deducted. And in order to maintain that balance between assets and liabilities, so your assets should be equal your equity and liabilities. To maintain that balance, you need to have debits and credits, and you need your debits to equal your credits. And we also discussed that assets increase by debits, assets decrease by credits, and liabilities and equity increase by credit and decrease by debit. And revenue is similar to assets and to liabilities and equity, and expense is similar to assets. So expense increases by debit and revenue increases by credit. That is why the other explanation for accounting equation is that, okay, assets is what you own, but what you owe, your liabilities and your equity, is the source to finance your assets. So when your business acquires an asset, you either invested your funds in that assets, or maybe you invested a bit of your funds in that assets and you invested liability. You take a loan to invest in that assets. So assets still equal to liability. And when we generate revenues, revenues are also the sources for our assets. So you instead of investing your own funds and your liabilities in the assets, you could have generated revenues and also invested in your assets. And that's why revenues are similar in nature to equity and liabilities. In fact, when you generate revenues and earnings, these earnings, they go to retained earnings in your equity. And that's some of the logic between revenues being similar to equity and liabilities. So revenue is a source of equity, and that's why it kind of behave itself like an equity. Increases by credit, decreases by debit. And expense is just the opposite of revenue. Like the liability is somehow an opposite of assets. In the same way, expense is opposite of revenue. So it behaves opposite to equity. So basically, expense increases by debit and decreases by credit. Okay, so we did an exercise to learn by heart some debits and credits, some assets account, liability account, equity account. And we did quite an extensive practice for these transactions. Hopefully you understood through practice. Hopefully you learned through practice how to increase inventories, decrease inventories by credit, increase cash by debit, and so on. We learned structure of balance sheet, income statement, so we haven't learned cash flow yet, but we will catch up on that. We will catch up on cash flow, no worries. We discussed that balance sheet accounts are permanent nature and they accumulate historically from the start, from the first day of your business till the last day of your business. Okay, and we also discussed that income statement accounts are of periodic nature. So you usually work in the income statement account for 1 month and then you kind of close that month, and all that income, it is flushed to retained earnings. If you remember, we did some drawings of the T accounts to cover that. If you still have questions and if you think I explained it poorly or not, or I provided not enough explanation, just throw me a personal message on Messenger and on Telegram, and we can have a discussion about that. At this point, when I'm developing that course, I value any form of feedback to make the course better. Okay. Then we dig into some IRS documentation. We discussed, we looked into a bit of guidance. We discussed that for, I would say for regular person, not for advanced tax accountant. For regular person, probably IRS publications is the best source of accounting knowledge. The tax experts, they usually look directly into legislation. So these publications, they are built by IRS on the basis of tax legislation to make it more understandable to a regular person. So for now we are good. We take a look in publication 535, publication 538, and we are working as part of the homework. We are working on our tax memo. Preferably you can develop it yourself, but I will work on that with you too in the later homeworks. Okay, what else do we have here? So we worked on the tax documentation. We started working and we continue to work on an accounting research. Let me know if there are any sound issues. I need to take a look. Just give me a second. 1, 2, 3. Okay, my microphone is working. From time to time I'm getting sound issues, and thanks everyone who noted that and lets me know. Okay, so we dived into IRS documentation, and currently we are diving in the accounting guidance, revenue accounting guidance, and today we will have a big lesson for that point. We will do a bit of Googling and research just to kind of collect main repositories of data. Learn how to prepare financial statements and where to find guidance. If you remember, during working on balance sheet and income statement, we dig into financial statement preparation guide. It can easily be found in Google as everything else. So here I worked in PwC in the past, so I preferred PwC guidance, but that's just a matter of habit. Other companies have great guidance too, so everything is available. Today we will do a small exercise on just making a document where you can keep your links to guidance. Okay, financial statements. Acquire practical skills, reporting software, Quickbooks, spreadsheets. So we've done a lot on that. If you think we can do, if we missed something interesting on the spreadsheets or on the Quickbooks, we will still be doing a Quickbooks homework. So if you think that we are missing something here, let me know. I'm open to any suggestions. Okay, and the last part is just continue research on your own based on your career aspiration, business aspiration, or based on your personal preferences or your business needs. Like if you need to learn something new for your business, you should be able to find the information and you should be able to structure it. Again, I'm not, I cannot tell you that I am like the last point of truth in accounting. I do have a 10 years of experience, but many items in accounting are judgmental, and I'm not dealing with some of the items on the day-to-day business. Like I do not work in QuickBooks on a day-to-day basis. I work in the different system. However, systems are mostly similar. They don't do them differently so that people can switch with minimal training. Okay, so let's go back to our homework 3. Where do I have it? Okay, it's here. So we had 5 new transactions for the business. We've already spent 15 minutes of the 30 minutes today. Hopefully that was a valuable update, and especially for something who just connected to the course. Okay, let me see. Do I have any? Okay, Irene, 11. Yeah, I don't. Maria, if you are online, let me know if I need to take a look on something here in your homework. Transaction list. Yeah, I think we did that last time, so I don't think Maria needs any updates. Let's move on. QuickBooks transactions. I do have last step here, for which I didn't provide the guidance. I will provide that today. I mean, instructional video. If you are going ahead of the schedule, you might have already Googled how to do that. But I will provide the links later today after the session. We have QuickBooks here. And we also have revenue guidance, and a task where we dig into revenue standards and try to apply it to a complex transaction. So here is some example. So here some other consultants review similar situations to which we have, and we also dive into primary guidance. We also dive into primary guidance, into PwC guidance for contracts with customers. Let's see if I have it open here. I have inventory here. That means that we will take a pretty short look at the inventory today, but that's going to be later today. Okay, so that's the standard, and we review its provisions, and we try to create an accounting memo here in the homework file. I'm doing that in my file, and I would expect that if you do homework, you do it in your file too. Let me check video quality a bit for a second. Okay, everything seems to be working. So revenue guidance. Revenue guidance, depending on the company which you choose, PwC like almost 250 pages. KPMG has a much bigger guide, like 1,000 pages, because it has a bunch of examples. And what we do here, the main essence of the revenue guide is 5 steps of revenue recognition. Identify the contract, identify performance obligations, determine transaction price, allocate transaction price, recognize revenue. And these steps, they are very generic, they are very general, and most of the day-to-day business activities, you probably won't even need to apply all of that, because everything will be very straightforward. You will have basic contract standard which you used for years. You will have one performance obligations per contract, like just deliver goods, and that's all. No subsequent service, no subscription, no advanced upfront payments. You just sell stuff, sell your revenues, or sell your service, or sell your good. Transaction price. And if you have one contract and one performance obligation, you will most likely have one transaction price to all of that. And again, since you have one of everything, you will not need to allocate anything. And then the last step, you will recognize the value when you satisfy your performance obligation. For goods, it's usually when you delivered the good and the title passes. So when you, if you sell X works, if you sell at the plant or at your shop, once the title passes to a buyer or its carrier, if you pass the goods to the carrier, then it's kind of sale is done and you record revenue. If you do services, your revenue recognition will happen ratably when you are doing your services. For example, imagine rent. Rent is paid every month and rent is accrued every month. Important notice that 5-step revenue recognition, it's based on accrual basis of accounting. So when we are talking about accrual basis of accounting, that's all where we need all that guidance, theoretically. Practically, most small businesses will just have very simple operation, and we do not need to give much thought about all of that. Okay, so we apply that to the accrual basis of accounting. And for example, in our homework, we have an example of QuickBooks. We are assuming we are into it and we are selling QuickBooks software. And we have a complex arrangement here. And we go through steps, we go through guidance, and we try to understand if our contract is the contract, how many performance obligations do we have. So far we assumed, because we do not have like a real contract for that, we assume that our contract is indeed a contract. But we also did some study about what needs to be done to say that we have a contract. And we also have a small piece of here. Then performance obligations. We actually have quite a few performance obligations. So performance obligations is something that we promise in our contract to do. And these promises should be separate promises. Like we promise set up a service, we provide subscription price for the service, we provide support services, we provide some tax return warranty if our software is used for tax return. We bundle all of that in 6,000 payment for 2 years, and we might also have some renewal price consideration. For example, if we discount heavily on the first year of usage, but then we want to recoup that in the second years of usage, that should also be accounted for. And here is like a life cycle of a SaaS service. QuickBooks is a software as a service and we have like a few stages of life here. The first one is setup and implementation, where we have training, configuration, implementation, data conversion, data cleanup, project planning, all of that stuff which most of IT projects have. Then we have initial term, where we can actually discount a customer and where we can provide some extra value for free in order to keep the customer, in order to make a customer kind of addicted to our service, to hook the customer. And it might have fixed fee, optional purchases, value added service. And then we have a renewal. So when customer is addicted to the service and when the switching costs are high, we will try to kind of charge a customer more for the service. A real life example of that is internet service providers like AT&T or Spectrum. You might have noted that you start your internet service with like $20, $30, $40 per month. And then after first year or two, they start to send you bills for 50, 60, 70. And that way, and if you call them and talk to them, they might be able to give you price back, your initial price. And that's because they just try to generate more revenue from you. And also, a same example with an internet service provider. In addition to your internet access, they will start to spam you and call you with TV offers or some streaming offers or some other bundle offers to just generate more revenue from you. As an accountant, we are like on the other side of the deal, and when we think how to recognize revenue from such transactions, which are basically kind of unfair, but business is business, nothing personal, just business. We need to think, how do we treat that? Do we treat internet service as a service? And then we need to estimate if we do some upsells. We need to estimate if it has an impact on our revenue recognition. So far we went through identify the contract step, and we basically concluded that we have a contract with a customer, and we have identified the performance. We haven't identified the performance obligations yet, but we will do in the next homework. We will do that. Let me take a look at if I have missed anything. Let me know if you have any questions. We are running out of time, and I will be sending you the link to the next stream. I do not see a lot of questions, so I will end this translation so that we have a couple minutes break between the translation, and let's meet in 5 minutes to discuss online researching, finding guidance. Thank you everyone for coming, and let's meet in 5 minutes.